to Geared for Growth. I'm your host, Mike Mortlock, and this is part 2 of the two-part series with Bushy Martin. Last week we had a look at the year that was 2024, what moved the needle, what was expected, what was a surprise that influenced property markets, and of course, I know everyone's interested to hear his thoughts on what 2025 will bring for property investors. What's going to stay the same? What's going to change? How's the market going to perform compared to 2024? And what sorts of things like interest rates, like employment, like immigration is going to influence the outcome for 2025 and how you can take advantage of it? An awesome episode, and here's Bushy. Bushy Martin, thanks for joining me back for episode 2 of our two-part series, which was 2024, the year that was, and now the big one, the one that everyone wants to know, that crystal ball of where should I buy in 2025, Bushy? Where's going to outperform Perth? Where's the next Perth?
Oh, mate, I'm lining up here with clickbait headlines that are going to pinpoint almost to the address where people should be buying, mate.
People are going to be very disappointed, I think, if that is the title for this show. And of course, if you didn't listen to the first one, I encourage you to go back to that. But we sort of talked about people being drunk on the sugar hit of the hotspot, and really to be successful in property investing, yeah, it's great to time the market, but you do need to be in the market for a period of time. So if a market can grow 25% a year for 2 years, it might not necessarily outperform a much more modest market that is a perennial performer. And I think that's where people are getting a little bit wrong, right?
Yeah, I do. I think there's way too much focus on what may change and not enough focus on what is unlikely to change. And I think if you look at successful investors in any asset class, they're the ones who focus on the fundamentals and ignore the noise. And there's one thing that we have seen a ramp up in exponential growth in the last couple of years. It's the noise. Because not only, as we spoke about in the last episode, not only are the mainstream media focusing on it because, one, they don't have much else to talk about. Two, they've got stakes in realestate.com and Domain, so they've got a pretty good reason to be talking it up. So we add that into the exercise, and suddenly we're in a position where the noise keeps us scared, and any form of media likes to scare us because that's our most fundamental instinct. And if we hear fear, that we're going to focus on it. So that works. That sells advertising space on newspapers and TV channels. But on a similar basis, at the other end of the extreme, as we touched on last episode as well, we've got an increasing number of instant overnight self-professed experts in the property sphere that everyone with a microphone's got a podcast these days, Mike. You and I have been doing it for a long time.
I was going to say present company accepted.
Yeah, but you and I have been doing it for years. They're popping up every week almost, and great delivery, great production, the socials to promote it, fantastic. I take my hat off to them. They're a world ahead of me in that regard. But we need to get back to what the fundamentals of property are and have a look at what that is doing and where that's heading and make decisions around that. And then the other layers of the onion they're almost like volume switches, some of the other influences that the media keeps talking about. Yes, you need to take them into consideration, but the old philosophy of expecting the worst and of planning for the worst and then expecting the best is the best way to approach property in any environment. So I guess that is a bit of a backdrop. Should we talk about before I reinforce what some of those unchangeables are, should we talk about some of the things that may change?
Yeah,
and will have an influence?
What might change, and of course, being a finance guru, I'm very interested on the big RBA elephant in the room as well. But what have you zeroed in on?
Well, let's start there. Let's bring that one up. Everyone's waiting with bated breath for when rates are going to go down. No question about it. And if we had this conversation 6 weeks ago, I probably would have answered it differently to what I'm going to now, because I would have anticipated, given where things are at, that we would start to see rate reductions early in the new year, and then probably get a progression of reductions of around about 1% over 12 to 18 months is where I would have positioned it.
Yep.
I'm not so confident around that now, Mike, and I need to underline here that I'm not an economist either. So I'm just a property player who spends a lot of time looking at the data and reading between the lines. So, you need to take my comments with a pinch of salt in that context. But I think the change that I'm now seeing and what's driving us to some degree is that everyone focuses on inflation, and sure, inflation is a thing that is impacting on rate decisions from the RBA.
Yep.
What is tend to being ignored, I think, and governments are finding this out right around the globe, is that while inflation may be coming down, so the rate of inflation is less, we're still talking about growth in prices.
Yep.
And prices have gone up 40-odd%. So if we're adding 40% to everything, that's not going down. The inflation rate might be coming down, but it's still growing. Might be less, but the pressure that's putting on families generally, again, the silent majority who are sucking it up, really, given some of the savings they may have put away and the equity growth they've enjoyed in their homes post-COVID, has allowed them to get to this point. But I think we're pretty close to the edge in terms of the sentiment that's attached to that. And that sentiment's going to have two big impacts, because we're coming into an election year in 2025.
Yep.
It's going to happen before September at some point in time. Whether politicians like it or not, and whether it's true or not, the performance of what hits our hip pocket is generally directed straight back to the government of the day.
Yes.
And just about every incumbent in government around the globe that's had an election over the last 12 months has been overturned. Regardless of policy, it's all about hip pocket. So we've just seen that happen in the US, where the tangerine tornado has come back into the chair. And God knows what havoc that's going to create. But when you see someone that is potentially as unlikable as that particular individual, but still manages to charge in, that's telling me that the general populace has had it up to the neck with the political speak, had it up to the neck with the fact that the cost of everything has gone up. And their hope is that maybe they're choosing between two evils, that the one that they put in may actually improve the position as far as their discretionary spend and the cost of living is concerned. So I think the cost of living exercise, while that focus is all narrowed down to interest rates, inflation is a key. It's what's behind that people need to be thinking about, and then flowing through that into the interest rate environment again. I think we're likely to be high for longer, and then there won't be as many rate drops. Why do I say that? Global parity really is, I think, what's going to drive it, because what's likely to happen if, and big ifs here, if Trump manages to actually enact his political promises, then that's going to be very inflationary for the US. Why is that going to be the case? They're talking up to 60% import tax on China, up to 20-odd% import tax on most other countries. I think this week I just heard that they've started the opening gambit as 20% in China and 10% elsewhere, particularly Mexico and Canada. Why does that matter? People are probably thinking, what the hell are you talking about the US, Bushy? We're talking about Australian property. Well, the ripple effect does flow through, and the US economy is by far the biggest economy in the world. If the cost of goods into America increases, inflation will increase. They're likely to increase their rates. That's the simple maths. And to make Australia competitive, to continue to get people to invest in Australia, our rates have to be at or near where they are. So if we're too far below, that's a disincentive for anyone to put their money into Australia, and Australia will suffer as a result. But there's a flip side to that as well, because if we're adding cost to the tariffs from China, where over a third of our exports go, in an economy in China that's already been struggling a bit, it's pretty soft over there.
Yeah.
Then the direct flow back into Australia is reduced need for resources, and that's going to flow through into an impact, I believe, in Western Australia in particular, and regional Queensland as a result, where most of the resource mining and production actually occurs. So I think, I've rambled a bit there, Mike.
No. You tied a nice, neat bow in it, and it just makes me think about. Do you remember the surprise surplus we had in the budget? I mean, that really came down to, I think, two things. One is that unemployment was lower than we expected, so less welfare, more wage earners, more tax revenue. The other one was that the prices that we had predicted for thermal and coking coal was probably about half of what was forecast, and that leads me to think about places like WA and, of course, the economy itself, which, there's people saying that we're in a per capita recession. We are actually perhaps not at the peak of things like coal and iron ore, but we're strong, we're solid, right? There's probably more room to go down than up.
Yes, spot on. And I think that you've touched on another really good point there, I think. And that is while all the talk in the media is about inflation and interest rates, and employment. I mean, the employment numbers are really strong. What's missing and what's affecting each and every one of us is wage growth. So everything's gone up except our wages. Yep. So we're spending a hell of a lot more to get a lot less. And then governments are wondering why they're getting overturned. I think Albo and the team would be, if they're not already, they should be extremely nervous about what we're coming into in this election year, because the opposition doesn't need to be that good to get in, because of people are just right. Well, it can't get any worse than this. Let's have a crack at the other side.
Well, Peter Dutton, I don't think as an individual has been less coveted than any other Liberal leader in recent history. I don't know what about his expressionless face just doesn't connect with people, but it's not kind of working. But it just kind of makes me think when Albo says, I've never lost an opinion poll, and he lost one recently, then maybe if he's losing to Dutton, that's an indication that it's not looking real good.
Well, yeah, you're exactly right, mate. It's less about Dutton and more about the incumbent, and I think that's what we've seen in America.
Yes,
if you look at the character they use of the winner of the election in the US, who can change direction in 180 degrees in the space of a sentence, and still not be questioned about it. Then on a very watered down exercise here in Australia, then the personality of the opposition, I don't think is going to matter too much, sadly.
I remember when Clinton was impeached, and I don't know why I started fostering these values, but I assumed that when you get impeached, you're not the president anymore. But we've got a president that was impeached 3 times and is a convicted felon, the first one in history. What an auspicious honour that is.
Don't start me, Mike.
We better move on. What else is going to change? Talk to us about things like listings, immigration. What are all the levers that you're looking at that are likely to be influential in 2025?
Yeah. So again, if we take that layers on an onion analogy, the things I always focus on, because I think you can create your own economy in property. Because all you need to do is solve someone else's property problem, and you're going to make money. That's as simple as it gets. So if you, this is what I say, annoy some of the top level noise, because if you focus on those 3 I's that we spoke about in the first episode, new infrastructure, new industry, strong and growing incomes, and then and that gets below medium levels. One of my pet hates is the focus on aggregated information over state levels and using median prices as the guide, because you and I know that there's a whole world of truth that sits in below that.
Yes.
But what it does do is influence sentiment, which can sort of corral the stampeding herd.
Yes.
Which is what we've seen in WA and Adelaide. But beyond those base fundamentals of future growth, I think the things that will influence the edges, and it will be locationally variable, as a consequence of that are listing levels. So I think what's tended to logjam the situation in 2024 is the fact that capacity constraints meant that there's probably a lot more people that wanted to sell but couldn't sell because they couldn't buy the next place.
Yeah. Yep.
So
Too much heat became that sort of self-fulfilling prophecy, because it's like, well, we don't want to buy in this rapidly accelerating market because, I mean, we're selling and we're missing out on that. And if we can't, grab hold of something, then it's just going to gallop away on us.
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Well, and adding to that as well, Mike, the borrowing capacity, because borrowing capacity has dropped very substantially, that they've got a loan on their existing home, but when they sell that and they front up to get a loan for the new one that's at or above what they've just spent, they can't get it.
Yeah.
And the smart ones are talking to their broker or bank before they put the for sale sign up and go, holy hell, I'm stuck. I couldn't move if I wanted to, unless I'm going to accept something a lot less than what I've got. So you don't do it. So I think that's had an influence, that those borrowing capacity restrictions have had an impact at that level as well, in terms of people just not wanting to be able to release their properties if they can. So I think, but I think there's going to be a shift in that. There'll be a lot more people that have to, and we're already seeing with banks that they're actually loosening. They're not making any noise about this, but they're loosening the threads in relation to borrowing policy, which is making it a bit easier, because banks are businesses as well. And if they're not writing enough loans, they're not giving a big enough return to their shareholders. So we're starting to see that loosen a little bit. When those rate reductions come in, and they will come in, but just not to the level that probably people have been expecting, and maybe taking a little bit longer for that to happen, then I think we're going to see more listing supply come in, which will tend to soften price growth across the board. And unless areas have those three I's happening with them, then they're likely to go slightly back and then sideways for an extended period of time. I think that would be my read of the capacity constraints that are caused by the interest rate piece. The immigration piece, well, that's a two-edged sword as well. So if we look at the demand and supply side, yes, the migration levels are coming down, but I'm a big believer that you don't shrink to grow, Mike. And we've got this massive bell curve of baby boomers coming out of the workforce that are going to need to be supported by other taxpayers to fund their health bills as they get older and sicker. If we don't have a very strong, healthy migration intake with the right skills, I think the issue with migration has been that we're concentrating them all in one place, and we haven't been fussy enough about the skills that we're attracting to make that happen. So I think there needs to be a diversification policy around where migrants can land. Yeah, because they don't have much choice the way it's currently set up when you dig into the details of that. Right. So if they were disseminated across the board so that we weren't causing these rental spikes, particularly in Melbourne and Sydney, but it was more across the board, that would alleviate some of the issues around that. But while the numbers, I think they're getting back to 250,000 a year over the next couple of years. It's a bit more than that this year, but we've had a big catch up. Remember, we closed the borders there for a couple of years. Yes, yeah. So we've need that to occur. So I'm not one of those that's supportive of eliminating migration. I think that would be a disaster move. But there's going to be continued demand on that side. On the supply side of the equation, as we touched on briefly in the last episode, that ain't going to change anytime fast, because regardless of what everyone says, you can throw as much money as a problem as you like. But I've heard some big numbers quoted in relation to how under-resourced we are in the construction industry. Yeah. It's something like, 81,000 short of what we would require to have any chance of just maintaining existing construction levels. And then if you add in the pain that the construction industry is feeling, plus the delays that occurred as the result of the 3 levels of government that are involved in approving that process, well, demand's going to get worse. Supply's going to get worse, not better. So, but all of that is great news for investors.
There you go. That is good.
We want scarcity. We want
absolutely,
scarcity, mate.
I think you're spot on with the construction too. I'm reading numbers of 90,000 shortage to be able to hit the housing accord. Depending on if you're looking at HIA or master builders, one of them is saying 2027 will hit the target of 240k in that particular year, but in no other year. And it's a high interest rate environment, and we saw material input costs rise 33% during the COVID pandemic. We've had a lot of construction liquidations. It's about a quarter. Almost a third of all companies in the last 12 months have been construction companies. And, any construction company that's still trading is wanting to recoup those bad couple of years where they had those fixed price contracts where many projects were happening at a loss. And, I feel like it needs to be a lower interest rate environment for these projects to stack. And there's lots of data saying the percentage of Melbourne apartments selling for a loss is peaking at like around 40% compared to maybe 20% pre-COVID. There's so much pointing to the fact that construction is not going to be the saviour to house prices in 2025.
Spot on. I think the other associated issue with that, which feeds off what you've just mentioned there, is that we have a tremendous history of supplying the wrong type of accommodation in the wrong spot at the wrong time. And that just adds to the problem. So if we're going to jam-pack sardine-canned apartments into city arenas that the developers are going to lose money, I don't need to say much more.
No, you don't. So, I mean, that's where you've really probably transitioned us into the what won't change. Immigration's going to be less than what we expected, there or thereabouts. Interest rates, it's not going to be a saving grace, but we might get some cuts later in the year or in and around the election, whenever that happens. We're still going to have government fiddling around the margins. We're still going to have people saying this is the next hot spot, when you and I would agree, it's good to time a little bit of boom and jump into the next one where you can, but it's the long-term performance that makes a difference. But if we are zeroing in as investors thinking 2025 is where I really want to, what's the opposite of keeping your powder dry? I've never heard someone say, I want my powder to be wet, but that's what I'm getting at. If someone wants wet powder in 2025, what moves should they be making?
Well, it sounds very boring and unexciting, Mike, but good investing is very boring and unexciting. It's like watching paint dry and grass grow if you're doing it. But if providing your investment horizon is long enough, and I almost ad nauseum say to people, if you're getting into property, you need to be in it at least for 15 years and more. Not just for the growth, but also as an insurance policy to make sure you're going through that full growth cycle. And if you are, then location doesn't mean so much. There's so much focus on location and this hotspot stuff. That's okay, but if you're adopting that long-term horizon where everything reverts to that mean, then locationally, providing it's got those 3 I's that I keep banging on about attached to it, infrastructure, industry, incomes, then you're going to be okay. So I would be really focusing on, all this information is for free. You've only got to spend some time on the internet looking at where the new infrastructure is heading. And I'm talking about committed infrastructure here, not political promise infrastructure that never seems to eventuate, but the real stuff that's occurring. And, the Cordell's, and there's a whole bunch of infrastructure sites. You'd be all over it like a rash, I would have thought, Mike, in relation to knowing what's happening where. So talk to Mike. He's the man. He'll tell you where the infrastructure is going to happen. I just dobbed you in there, mate.
Yeah, cheers.
But definitely follow that. Definitely look very clearly at where the new industries are happening. So the renewables and everything that goes with that. Have a good look at that in that context. And then that income play that I was talking about, but it's then really just a scarcity game. from there, because we've seen this affordability location balancing act happen over the last couple of years. There isn't going to be another Perth or Adelaide, I don't believe. I think those days are actually gone. Avoid those market makers that we spoke about in the first episode. So I would, what's the saying? There's lies, and statistics. Well, there's lies, and data in our current exercise. So be very careful of what data that you're listening to, but make sure it's forward projecting as far as that goes. And then beyond that, because it gets right down to the street and property level in relation to property. So ignore the median price stuff and the negative Nellies in the media, as well as the hotspotting kings at the other end of the scale pushing a certain location. Become a contrarian. Focus on those fundamentals that I spoke about. And then for me, if you're looking at being in the sweet spot of scarcity in terms of supply and demand, then a good quality 3 to 4 bedroom home in a tightly held area in a good school catchment location that has the 3 I's that are about to happen and has lifestyle amenity attached to it, that's about as difficult as it actually needs to get.
I was going to say, it sounds pretty simple when you put it like that. I mean, it's hard to build a course around. It seems like everyone's building a course. I've noticed you haven't got one, so...
But it isn't much more difficult than that if you're really focusing on it. And I think one of the mistakes that I see a lot of investors make around this arena is there's a big talk. There's two things. There's big talk about investment grade property.
Yep.
And that's okay. Yes, a property's got to tick the investment boxes, but the way to really make property work for you is to grow its value, then sell it to create an income at the other end of the journey, which means that whenever you buy a property, think about who you're going to sell it to. So if you're buying an investment grade property that's only going to appeal to investors in the future, you've just dudded yourself out of 7% of the buying public who buy on emotion, not on rational spreadsheets. So it must have that X factor owner-occupier appeal. It's got to look great from the street. You've got to do some dancing in relation to the kitchens and bathrooms and you can do this after you buy it to actually give it that uplift that creates the X factor that then gives you the opportunity to maximize your manufacturing of growth during that period. So that's one factor. The other thing that I wouldn't mind just touching on, Mike, and I know it's probably near and dear to your heart, is that I'm sick to death, quite frankly, of hearing about property professionals downing new build construction properties. And I'll tell you why. Yes, off the plan gets a bad rap, and quite often appropriate. But if you apply everything that we've spoken about, a good quality 3 to 4 bedroom home in a tightly held area that doesn't have acres of greenfield development sitting on the side of it that's going to dilute its value and keep it down. But if you can apply a new build exercise to a property that's got all those other parameters working toward, not only are you going to get the stamp duty benefits in terms of the cost reduction, but there are very significant depreciation benefits that are still applied to new builds that you don't get on existing. And the big piece that very few investors focus on is the ongoing affordability of that property. So,
yes.
Like you, a lot of the work we do with investors, we get right down to how much per week is this property going to cost you in year 1, 3, 5, 10, 15, beyond, based on every cost in buying and holding that property. If you don't know that number and all you're going, here's the rent, here's the mortgage, I think I can afford the gap, you're in for a big shock and a big surprise. And I think that's the reason why over half of first-time investors sell a property in the first 5 years, because they haven't got down to the nitty-gritties of how much is that property actually going to cost you to hang on to.
Yeah.
So I think within all of this, if you can, and it's still the ability to do it. Yes, the construction industry is in strife, but there are also a lot of builders that are starting to struggle for opportunity. If you can negotiate fixed price so that you can control scope, quality, and cost, then a very smart investor can do very well at securing a property with those scarcity factors, but also has that cost affordability working for them, so that they don't have to live on baked beans and dog food while they hang on to the property.
Yeah, I think that's a really important point, because the data still says that, 91% of people only ever own one investment property. And I think it's because they get the first one wrong. And the easiest way to get that wrong is to not understand the cash flow and be forced into a position to sell. And that, maybe you'll bounce back financially to the point where you could get into property again, but you've had this pain lecture that just makes it it's insurmountable to think we could go back. But understanding the cash flow and how much it's actually going to cost you each week, and how to sort of put a little bit of a soothing ointment on top of that, we can go, okay, well, if it's growing 5% per year, like on net, it's actually putting this in our pocket. We just don't have it in our bank account, but we just need to cover that. I think if everybody went through that exercise, I think those statistics would be better.
Totally agree. And again, I think there's inappropriately a lot of negativity thrown at the new build piece. It's like anything. If you the devil's in the details. If you get those details right, then I'm a massive proponent of building. As an architect and a project manager many years ago, Mike, that's all I did every day of the week. So I've got real confidence around what new build properties can do if you get all of the other parameters lined up. And in terms of using all of those depreciation and tax incentives to actually smooth the cash flow so that you continue to live while your property grows in value, happy days. One other quick thing that I'll mention, because I know you're under some time pressure, one of the other things that, in addition to following the infrastructure, so without naming names, because I don't like doing that in terms of location, but major infrastructure projects like the Inland Rail project, there will be regional hubs that have enough critical mass there that will be worth investigating.
Yes.
I believe that it still has to have those three eyes applied to it beyond the rail exercise, because if it's a whistle stop, that's a very different story. But there will be locations there that are worth investigating. The other thing that I think is worth slipstreaming on is these massive cashed up boomers that are choosing lifestyle locations and paying cash for property. You're going to put pressure on prices in those locations. I think there's 6 million boomers. About a quarter of them are going to be making the change from the right sizing from the big house that they're rattling around into a more maintainable lifestyle accommodation. Those sorts of lifestyle locations that still have and I'm talking locations that have 25,000 plus. So there's a critical mass of population there, and there's not too many renters in those locations. A smart investor can arbitrage on that and then slip in behind them and ride some of the growth that will come out of that.
Yeah, and I think a smart government will continue to incentivise downsizing, because that can help with household formation rates, which you move a percentage point of that, and suddenly it's like, oh, we need 50,000 less homes. That's an interesting little thing that not a lot of people talk about. So yeah, that is a big one.
I think smart government is an oxymoron.
Yeah, sorry, you can dream. We can dream, can't we? All right, well, 2025. I mean, we'll get you back just to check in and see how your prophecies have fared. But I can't see any holes in that, and everything that you've shared on the year that was, I think, informs what investors should know about for 2025. And you've given some real gold for us to be zeroing in on, and a little bit of research for us as well, which never hurts anyone. So Bushy, thank you very much for joining us for a look at 2025, and best of luck to you and yours for the season.
Thank you, Mike. Always humble to be here. I'm just going to leave you with one thought around a good, appropriate title for 2025. If you're a Joe Cocker fan, and perhaps I'm showing my age here because I like music of all ages, I think it's going to be a whiter shade of pale.
A whiter shade of pale.
There'll be growth, but it'll be back at the sorts of levels that we've been used to pre-COVID. And we're going to see much more locational variation and out of sync activity, which was always the case prior to the pandemic petrol being thrown on the property fire.
I like that. Yeah, and I think we're right there. And to quote Joe Cocker, "Don't come in through the bathroom window this Christmas. You'll only frighten the guests." Thank you. I can't be serious with you, Bushy. Thank you for joining, and we'll have you back hopefully in the new year.
Thank you, Mike.
Cheers, mate.